Okay, let's unpack this. We are diving deep into a really interesting corner of the business world today, specifically consumer packaged goods, CPG. And we're zeroing in on protein, actually the ready-to-drink or RTD shake category. It's moving at breakneck speed right now.
Yeah, it really is. And what's great is we're not just looking at, general market buzz. We've got the prepared remarks from the Bellring Brands Q3 fiscal year 2025 earnings call. So our mission really is kind of twofold. We want to understand the CEO's strategic thinking, how they see leadership in this hot market, and then, yeah, drill right into the CFO's numbers to see what that strategy actually looks like financially. What does it cost?
Exactly. It's like we have the company's view on this huge market momentum, the big picture story, but also the raw numbers that show how they're trying to capitalize and, crucially, where the pressures might be building up.
Right. The CEO laid out basically three main points. One, this RTD category, it's got a long runway for growth. It's not peaking anytime soon. Two, Premier Protein, their big brand, its fundamentals look exceptionally strong. And three, they detailed the steps they're taking now to build momentum for the future. We need to check the data behind those claims.
Okay, so let's start with that first message. The category itself is on fire, accelerating. The CEO talked about these converging macro trends, right? The big focus on health, functional foods.
Right, functional nutrition and also convenience. People want easy options. And interestingly, they specifically called out the rise of GLP-1 usage.
That's huge. The weight loss drugs.
Exactly. That inclusion is a massive insight, I think. It signals these shakes aren't just for, gym goers anymore. They're becoming essential nutrition for this rapidly growing group using these medications who need that protein to maintain muscle. That really changes the potential market size, doesn't it?
It really does. And the data backs it up. RTDs grew 16% this quarter. 16%. That's staggering for CPG. And importantly, 70% of that growth was volume, not just price increases.
Yeah, volume-driven growth is what you really want to see. It means more people are actually buying the product. And connecting that to the bigger picture, the market seems nowhere near saturated. Now, 1 in 2 households consumes RTD shakes. Think about that. The category added 5 full penetration points in just the last year.
Wow, 5 points in a year.
Yeah, apparently that's the second highest increase of any category in the entire store. Only prebiotic sodas grew faster in penetration. That level of adoption is, well, it's pretty wild.
And Premier Protein is right at the front of that wave.
Yeah.
They contributed about a quarter of that penetration growth.
More than any other single brand, yeah. So they're not just riding the wave, they're actively making it bigger.
So how are retailers reacting to this?
Well, the remarks said they're definitely noticing. Store operators see the potential. They're accelerating growth by giving the category more space. And interestingly, testing higher traffic aisle locations.
Ah, so moving them out of just the nutrition aisle.
Exactly, putting them where more shoppers might see them, plus expanding displays, end caps and things.
And at the same time, they mentioned retailers are kind of cleaning house.
Yeah, that was an interesting point. The CEO said retailers are concurrently de-emphasizing less productive and in many cases declining subsegments and brands. So basically cutting the losers to make more room for these fast-growing RTD shakes.
Okay, that makes sense. But more growth, more attention. That usually brings more competition, right?
It does. And the CEO addressed that. They framed increased competition, especially from the big CPG players, as validation. Yeah, like it proves the category is legit and has long-term staying power.
Yeah.
The argument is more competitors mean more shelf space overall for the category, more marketing dollars being spent, and ultimately that helps drive that household penetration even higher.
I get the optimistic spin, but validation can also mean things are about to get really expensive, right? Price wars, marketing battles. Isn't that a risk to Bellring's margins if these giants jump in seriously?
That is absolutely the core tension here, and it's something we need to keep in mind when we get to the CFO's numbers later. But for now, their argument for more growth potential is pretty compelling. I mean, 52% household penetration sounds like a lot, but it's way behind mature CPG categories, which are often 80%, even 90%.
Right.
And get this, the whole convenient nutrition category only takes up about 1/3 of the physical shelf space compared to other food categories of a similar sale size. So they have a solid case when they go to retailers asking for more space right now.
Okay, so the category's booming. Let's zero in on Premier Protein itself within that market. They're number 1 in RTD shakes, right? About 25% market share.
Yep, number 1 in RTDs and also number 1 in the broader convenient nutrition category overall. They are the leader. And their specific metrics look really good. Q3 consumption, so what people actually bought, grew 19%. And volume drove 60% of that gain, which, again, is healthy.
And penetration is still climbing.
Hit an all-time high for the brand, 21.6% of households. Loyalty metrics, buy rate, all strong. They're the #1 velocity brand, meaning their products fly off the shelf faster than anyone else's when they're in stock. And their shelf presence, measured by something called Shake TDPs, total distribution points, is up a massive 34%.
34% more shelf presence.
Yeah.
That's significant. There was one stat that really jumped out at me, though.
Which one was that?
They sell 36 shakes. Every single second.
Yeah. 36 shakes a second. It kind of puts the scale into perspective, doesn't it? That's the kind of volume keeping their plants running constantly. But, and this is the key point the CEO made, even at that scale, they still only have about 20% household penetration. So that runway, it does seem genuinely long.
Okay, so how are they planning to defend that leadership and keep growing, especially with that competition maybe heating up? They talked about 3 levers.
Yeah, 3 key enablers, they called them. First one, brand support. Makes sense. They launched their first big media campaign since 2021, said it had strong ROI, and then they followed up with a second wave in July featuring updated packaging.
Ah, the packaging refresh. Why now?
It's aimed specifically at improving discoverability on that crowded shelf and also appealing to younger consumers trying to broaden their base beyond the original core.
Okay, brand support. What's number 2?
Distribution expansion. This seems critical. They pointed out this gap. Premier drives 11% of the category's sales, but only has about 4% of the actual shelf space.
Whoa, that's a big difference. 11% of sales from just 4% of the shelf.
Exactly. It shows how fast it sells when it is there, but also how much opportunity there is just by getting more facings. So they're going after it aggressively. More promotions, more displays, demos in stores. They've even set up a dedicated team and a new broker partner specifically to fight for that shelf space.
Makes sense. Fight for the real estate.
And the third lever.
Innovation acceleration. Keeping things fresh. They launched 2 new shake lines just this year. One was the Indulgence line.
Indulgence. Sounds like dessert.
Sort of the idea. Targeting different drinking occasions, maybe more treat-like. It's apparently doing well. Got into club stores recently. The other big one was their almond milkshakes.
Oh, non-dairy. That's a big move.
Yeah, their first non-dairy protein shake. Launched late June, so still early days, but they said initial results were promising. And the pipeline sounds full, both close-in stuff like new flavors, different pack sizes, and also big-eye innovation, aiming for more disruptive products to pull in totally new consumers. So strong brand, pushing distribution, pushing innovation. It sounds like a solid growth plan, but like we talked about, growth like this, especially fighting for shelf space, it costs money, right?
Absolutely. Which brings us neatly to the CFO's part of the presentation. Can they afford this speed and stay profitable? That's the key question.
Right. Let's pivot to the Q3 financials then. What did the CFO report? Top line looked pretty good.
Yeah, top line was solid. Net sales hit $548 million. That's up 6% from last year. Adjusted EBITDA, that's a key profit measure, was $120 million. Pretty healthy 22% margin.
Okay, 6% growth, 22% margin. Seems decent.
It was. Though the CFO did add a little caveat. Results were actually slightly ahead of what they expected internally.
Oh, why was that?
Mainly because of a heavier than expected e-commerce promotion load-in. Basically, more promotional inventory got shipped out to e-com retailers in Q3 than planned, boosting Q3 sales slightly. They expect that to kind of reverse or deload in Q4, just a timing thing mostly.
Got it. And for Premier Protein specifically, sales grew 6%.
Net sales, yes, 6% growth. Split pretty evenly, 3% from volume, 3% from pricing. But here's where it gets interesting, connecting back to consumption. Remember we said consumption dollar growth was 19%?
Yeah, much higher than the 6% net sales growth.
Exactly. That gap is because of trade inventory changes. The CFO called it a high single-digit headwind to Q3 shipment growth. In simpler terms, people were buying way more shakes, up 19%, but retailers actually stocked less inventory on their own shelves during the quarter compared to before. So Bellring's shipments to retailers, their net sales, didn't fully reflect that strong consumer demand in Q3.
Okay, that makes sense. Inventory fluctuations. What about Diamond-Eyes, their other brand?
Diamond-Eyes net sales were up 5%, mostly driven by good growth in international markets and also their domestic RTD shakes.
All right. Now let's talk margins, because that's where we expected to see some pressure, right?
Yes, and we did. Adjusted gross profit margin landed at 35.1%, but that was down 130 basis points or 1.3 percentage points compared to last year.
Okay, 1.3 points down. That's a noticeable squeeze. What drove that?
The CFO laid it out pretty clearly. Number one, input cost inflation. Ingredients are costing more. Number 2, incremental trade spend. That means paying more for those promotions and shelf space we talked about. Number 3, costs related to the packaging redesign. And finally, they were comparing against a prior year period that had some one-off cost benefits, making the comparison look a bit worse.
So a mix of rising costs and strategic spending hitting the gross margin line. What about SG&A, the operating costs?
Well, the headline number looked high because it included a big one-time hit, a $68 million provision for legal matters. It was related to an old, discontinued brand called Joint Juice. Sounds like they reached a settlement in principle.
So excluding that one-time legal cost.
Excluding that, SG&A actually decreased as a percentage of sales, down 40 basis points, which shows good cost control on the underlying operations, good operating leverage as sales grew.
And how's the balance sheet looking? Cash flow.
Yeah.
Debt.
Pretty stable. Generated $40 million in cash from operations in Q3. Net debt was just under $1 billion, $971 million. Net leverage was 2.0 times adjusted EBITDA. They expect that leverage ratio to end the fiscal year below 2.0x, which is pretty healthy. And they were active returning capital, repurchased 1.3 million shares for $83 million during the quarter.
Okay, so Q3. Solid top line, strong consumption, but definite signs of margin pressure from costs and spending. How did that translate into their outlook for the rest of the fiscal year?
They tightened up the guidance ranges for fiscal year 2025, but importantly, the midpoint for both net sales and adjusted EBITDA remained unchanged.
So still expecting strong growth overall for the year.
Yeah, the updated guidance is $2.28 to $2.32 billion in net sales and $480 to $490 million in adjusted EBITDA. That implies, total year growth of 14% to 16% on the top line, still very strong, and 9% to 11% growth for adjusted EBITDA, with a margin around 21% at the midpoint for the full year.
Okay, full year looks solid. What about Q4 specifically?
Yeah.
Quarter they're in now.
Q4 net sales are expected to grow around 14% at the midpoint, again, mostly driven by Premier Protein, lifted by those distribution gains finally kicking in, plus more promotional activity planned, and that underlying consumer demand. Premier RTD consumption dollar growth expected to stay really strong, high teens to low 20% range.
Wow, still expecting 20-ish% consumption growth. But what about the margins in Q4? That's the big question.
And that's where the warning came. Q4 adjusted EBITDA margins are expected to drop significantly, down to approximately 19% at the midpoint.
19%, down from 22% in Q3. That's a big step down.
It is, and it directly answers that question about the cost of competition and growth. The CFO was clear about the drivers. It's mainly coming from lower gross margins. Reason 1, higher promotional spend hitting harder in Q4 as they really ramp up merchandising. Reason 2, stepped up input cost inflation, specifically called out protein costs hitting them more in Q4. And reason 3, those non-recurring packaging redesign costs and lapping the prior year favorability, that alone is about 100 basis point or 1 percentage point headwind in Q4.
So basically the cost to make the shakes is going up, and the cost to sell the shakes through promotions is going up even faster in Q4.
That's a pretty good summary, yeah. That's the squeeze they're forecasting for Q4.
And did they mention anything else looking further ahead, like into next year? Tariffs, maybe?
They did give a quick tariff update, said the potential impact has increased slightly, seeing 15% tariff rates now on dairy protein they source from New Zealand and the EU.
Okay. Is that hitting them now?
No impact on this fiscal year, FY25. They've locked in their supplies. But they do expect a low single-digit impact on their total cost of goods sold in fiscal year 26. They're looking at ways to mitigate it, but yeah, it's another potential cost headwind coming down the pipe.
Okay, so wrapping this all up, what are the big takeaways for you listening to this? It really feels like two major themes emerged from these remarks, didn't they?
Absolutely. On one hand, you have this incredibly dynamic, high-growth RTD category. The CEO's optimism seems kind of justified by the macro trends, the penetration gains, especially things like the GLP-1 tailwind. It does feel like early innings for the category overall.
Right, the growth story is powerful. But the second theme is the cost of leading that growth.
Exactly. Maintaining that number one spot requires really significant investment, not just R&D and fancy packaging, but serious dollars on promotion and distribution muscle. And when you layer rising ingredient costs on top of that strategic spending, well, you see the result in the margin pressure, especially that Q4 warning.
The growth is explosive, but leading the charge is getting more expensive. You can see it right there in the numbers.
You really can.
So a final thought for you to chew on. The CEO mentioned retailers are clearing out less productive brands to make space for winners like Premier Protein. As this competition heats up and retailers have to pick winners and losers for that valuable shelf space, how long can the sheer force of category growth keep lifting everyone? At what point does the pressure on margins force brands like Premier Protein to maybe pull back on that heavy spending or risk getting drawn into an even tougher fight? That feels like the key tension to watch.